Hello, and welcome to the fourth quarter outlook in the latest edition of the Capital Stewards podcast. Markets have continued to climb this year despite fears of rising employment and the fact that maybe unemployment is going to cause a recession. In this episode, we're going to talk about what's happening in the jobs market after some of those scary employment prints that we saw over the summer. The Mag 7 and growth stocks, they still lead the way in the stock market, but are we in for a change? Will those runs continue? We'll cover that in this episode as well. Where will interest rates go? Gold, oil, all those other assets that aren't just stocks. They've been kind of on a roller coaster over the summer, so we'll share our views on where that roller coaster ride is likely to land. Oh, and if you haven't turned on your TV, we have an election coming up. Will a Trump victory spark inflation? What about the tax hikes proposed by Kamala Harris? I'll dive into potential election outcomes as we close this episode out. So as always, these Outlook episodes are a little bit longer. I know you're going to want to listen to the entire thing, but in case you're looking for something more specific, check the notes. You can skip ahead to the different topics that I talk about. There's lots of charts in this episode, so if you're listening to the podcast version, consider watching on YouTube where you can see those charts. All right, so let's dive into the economy and markets as we move into the fourth quarter of 2024. So as always, let's start with what's happened so far this year. On the chart, you can see the S&P 500 stock index in the red line. That's now up more than 21% for the year. That's pretty strong returns, but only to be outdone by gold, which is up 27% since January. Not as many people have been tracking that. While home and building prices are generally flat to down, publicly traded portfolios of REITs or real estate are up about 10%. Most of that gain came in the third quarter as long-term interest rates started to fall a little bit. Real estate's particularly sensitive to real estate. Obviously, in a house, you know that has a lot of impact on what your mortgage payment is. The same thing happens for really big industrial and commercial builders. Bonds are now up more than 3% for the year, also mostly from strong gains in the third quarter as interest rates declined. We'll dive into the economy more in a moment, but obviously we have not yet had a recession. And so staying the course has been the best move for most investors so far this year. This year has been good, but most of our clients and most investors in general have long-term goals that extend far beyond 2024. The most important factor in successful investing is choosing the right assets and sticking with them over the long term. You can see over the last 28 years, the S&P 500 is averaging 9.8% a year in returns. Stocks produce the highest return over long periods of time, even when you consider recessions that happened in 2001, 2007, and COVID in 2020. Gold returns just over 7% annually, not too bad. Bonds just over 4%. All of that outpacing inflation, which even after the recent run-up in inflation is still averaging 2.5% over the long term. When we zoom in and look just the past decade, the S&P's done a little bit better. Returns have been more than 13% each year on average. Gold and real estate up around 7%. Bonds are actually the lagging asset over the last decade at only 1.8%. You can see the drawdown in bond performance as rates rose after COVID, and then much of that has turned around recently. So when you think about the 28-year and the 10-year history, you would be a very happy investor today if you had invested at the peak of markets before the global financial crisis or right before COVID. We're going to talk about the current state of the U.S. economy and markets in a minute, but investing solely based on whether we're going to have a recession or whether one's right around the corner or whether stocks are overpriced and valuations are too high, or, are we in a bubble? Are we not in a bubble? It's a bad idea. It's really difficult to make those calls correctly. Nearly 100% of the economists surveyed by Bloomberg thought we would have a recession in 2023. We did not. Stock values were really high coming into this year, and many people expected that the valuations were too high. We were just going to have a pullback. The S&P is now 20% higher, more than that really, than it was to start the year. So recessions and market drawdowns don't feel good. I've lived through plenty myself. Building a portfolio that you can stick with through the hard times is the best way to achieve long-term compound returns. So regardless of the rest of this outlook, if you don't hear anything else, think about your portfolio and the other assets that you own and whether you feel comfortable with those assets, regardless of the environment that you're in, good or bad, going forward, because that's going to be the most important determinant of your success. And if you're not happy, if you have concerns about what you own, then it's probably time to seek out some professional advice. That's what we help clients do every single day. So let's get back to the markets. What's been driving strong returns so far this year? Let's start by looking at the economy, and then we can dive down into specific asset classes. The jobs market has been in the news lately. Job creation and unemployment in the US are so important because consumer spending, so that's you and me, it makes up about 2/3 of the economy. So if consumers start losing jobs and spending less, that ultimately causes a recession. And if consumer spending holds up, then it's really, really difficult for us to have a recession. My view has been that the jobs market has come back into balance. We've been looking at this chart for the last few years and sort of assessing the gap between job openings and those looking for work. There are still more jobs than available workers. But that gap has closed significantly. We had a small gap between openings and unemployed workers before COVID. That was actually pushing wages up slightly. Prior to this year, most of the work to close the gap has been the reduction of open jobs. As businesses simply sort of hired fewer people, they closed open positions, decided to expand less, whatever. More concerning recently has been that the number of unemployed workers, the red line, along with the unemployment rate, has been rising. So we've seen some unemployment tick up as well as sort of a reduction in business activity. On the next page, you can see a comparison of the labor force and the jobs market measured by non-farm payrolls. On the left, you see really strong job creation coming out of COVID in 2021. The change in the labor force, and by the way, anytime we talk about the labor force, what we're really saying is the number of people that might be out there looking for a job. The change in the labor force lagged behind that really strong job creation. That's what created a lot of inflation in the service sector because people had jobs and they just had to pay more and more and more to entice people to fill those open jobs. But as we moved into 2022 and 2023, we saw the labor force growth sort of move up. We saw the labor force grow and fill all those open roles. Some of that was U.S. citizens returning to work. Some of that was probably from documented immigrants. I won't spend a ton of time on this here, but my general assumption, I know there's a lot of folks that talk about illegal immigrants. My general assumption is that folks that hire lots of illegal immigrants don't volunteer that information when the government calls and surveys them. The Labor Department, Bureau of Labor and Statistics literally calls and says, hey, tell me about your workforce. And they're probably not going to say, oh, yeah, these are the folks that I've been telling you about. I also have all these undocumented people over here. Let me just tell you all about those people. Probably don't do that. The same thing when government workers, despite all of the disclaimers that they make about how they're not going to, deport people or things like that. I just don't believe that they walk into a house full of illegal immigrants and everybody's like, yeah, I'm here and I'm working and everything's great. So I think more likely what we see is both legal sort of documented immigrants. There's a lot of those folks coming into the country and working, and then also U.S. citizens returning to work from COVID. But we see the labor force grow, and we see the labor force grow, but the number of jobs that is being created every single month and the growth in the labor force has been trending lower. And this chart, we kind of smoothed it over 3 months. So these things tick up and tick down. And so it's important not to get stuck sort of in any single month. It can go up, it can go down, those kinds of things. Got to look at it over a period of time. But you see things sort of slowing down. And all of that was good normalization post-COVID. We shouldn't be creating 600,000 jobs a month. You can see that on the left-hand side of the chart. 100 to 200,000 jobs a month was normal for the U.S. economy before COVID. So now we've reached sort of equilibrium, so to speak. The number of additions to the labor force is just about even with non-farm payroll growth. On the right, I subtracted the labor force growth from job creation to make it easier to see where we stand. So a number over zero means we have enough jobs and we're doing good. That's kind of where we want to be, just a little bit over zero every single month. And the line just below zero for any meaningful period of time, we have a problem. That means unemployment's going to go up, and because we're not creating enough jobs to support the growth in the labor force. So you can see in that chart on the right-hand side, we're hanging right around zero, the neutral point on the graph. It's important to remember the economy can hang on right here. We create just enough jobs for the workforce. We're doing okay. The problem in my mind is that the Fed still has rates at 5%, which is putting the brakes on the economy. So we know that rate cuts take time to work their way through the economy. So it seems logical to me that job creation is going to continue to weaken slowly over the coming months, even as the Fed starts to cut rates, because rates aren't going to magically get back down to neutral and stop putting pressure on the economy. So to me, the weakening labor market is actually the biggest risk to the economy over the next 12 months. We aren't in a bad situation yet, but I think we're getting close, and I think we're going to get a little bit worse before things get better. I think the Fed needs to resist the urge, and we'll talk about interest rates a little bit more in a minute, but they need to resist the urge to not cut rates just because folks are talking about inflation coming back. I don't think that's really the case. Layoffs do remain really low. My view is that companies are starting to economize, though. Operating margins look okay for the moment. That's what happens, when we look at big companies. No, nobody wakes up and decides to do layoffs. They don't want to do layoffs, right? They do layoffs and reduce the size of their workforce when they're having trouble making money, right? So operating margins are okay, but I think we're starting to see what I would call sort of stealth layoffs. Companies are calling workers back to the office 5 days a week on short notice. They're doing things where they sort of expect some of their workers to decide to leave their job, even though they're not laying them off formally. They're making it difficult for folks to work. They never would have done that 2 or 3 years ago when they just couldn't get enough workers. Now they're saying, hey, we've got enough people. And if some of you folks decide that you don't want to be here, that'll be okay. Historically, economists have assumed that the majority of the exits from the labor force, that's people that leave a job and don't file for unemployment because they stop looking for work, are voluntary. So people leave for family reasons or they move or et cetera. There was a good paper this past quarter from the Minneapolis Fed that showed that 40% of exits from the labor force are actually preceded by a layoff. So I think what we're seeing, and we have seen historically, is that more layoffs, and there are more layoffs happening in the economy than we think. Whether they show up in warn notices or formals or layoff statistics or not, I think there are more people losing their job than we think, and they're not necessarily quitting by choice. So I think a combination of sort of stealth layoffs and companies not really doing layoffs, but making it harder to work, and then just flat laying off more people than we think is going to continue to weaken the labor market over the coming months. It's also become much harder to get a job, according to surveys of workers, or at least they feel that it's a lot harder to get a job. So I think that's what folks sort of see in their local community, and they feel that. And so that's why things feel a lot softer than they were. So we're kind of wading around in the muck and the mire of the soft employment part of the soft landing. I think when people, a lot of times, we talk about what's happening in the economy and people say, oh, it's a soft landing, soft landing. That's not a recession. That's good. Well, the soft landing part means that things are a lot softer. They're a lot weaker than they were a couple of years ago. So we're kind of in the soft underbelly here for sure. Even with the most recent Fed cut, the Fed funds rate still sits at 5%. So we're walking around in the muck and the mire, and the Fed's kind of still got the brakes on the economy. Prior to the September jobs report, markets were expecting more cuts more quickly. That's now corrected a little bit, but you can see on this chart that the market is expecting the Fed to cut more this year and next year, dropping the rate down somewhere between 3.75% and 3.5% by next summer. The market and the median Fed member both. So when we look at the Fed's dot plot, their expectations of where future rates are going to go, and we look at the market futures, they both think that the long-term neutral rate, so the rate at which the Fed needs to have their short-term interest rate at in order to not be helping or hurting the economy, is about 3%. But we're still really high compared to the neutral rate and where we sit from an inflation perspective. If long-term expectations for neutral are 3% and the Fed's at 5%, they've still got those brakes on. Even when they go down to 4.75 and then to 4, they still have the brakes on. Meanwhile, we know from the unemployment conversation that we just had that we're sitting right on the balance of things going south, and we can't afford to go much lower without employment moving much higher. That causes a recession. You might hear some skeptics talk about inflation going higher again. I don't see that happening. Even with this past month's slightly hot print, the trend in prices is going down. Goods prices have moved lower and they're deflating. Prices are actually going down. Even if they took a little bit of a breather last month, that's been the trend so far this year. Businesses are saying that they don't have pricing power. What was more notable than the headline numbers in the September inflation report was that housing prices continue to move lower. The lag in housing and owners equivalent rent prices in the CPI is responsible for the print still being north of the 2% target. We know that if you substitute the measurement that they use in CPI calculations for more current housing market pricing, the CPI would actually be below 2%. If the housing related inflation continues to move lower, which I expect that to happen this fall, then inflation is going to continue to fall, despite what the Fed does. All right, so let's switch gears a little bit and talk about consumers and their wallets. Retail sales, the spending side of the consumer equation, continues to be positive, but sort of sluggish as well. 2% retail sales growth over the past year lags inflation. For context, retail sales typically were north of 3.5% prior to COVID. So they should rise slightly more than inflation in order to produce real economic growth. That's what we want. So not negative, but again, we're kind of walking around in the muck and the mire. So the economy is growing, if somewhat slowly. It's more likely that we're closer to 2% than the 3% number that we saw coming out of COVID. And I think what we're likely to see is some seasonality too, and even in the GDP prints, you'll see the Atlanta Fed now has got a current third quarter GDP north of 3%, but it was a lot slower earlier this year. So I think when we get to the end of the year, we're going to see something in the 2% range for economic growth. And so that's the economic backdrop that we kind of go into when we start thinking about how we're going to invest in stocks and other asset classes. That's the economic backdrop that we've got to make decision to inform our. That's the economic backdrop that informs our views on how we think about investing in stocks and in other asset classes. So when we shift to the stock market, it's important to remember that even though we tend to use broad indices as investment vehicles, the stock market is not the economy. When we invest in stocks, we're buying ownership in a set of companies that have revenues and profits. So it's important to dig down past the macro data from the news and see what's happening at the company level. Last quarter, I talked through a few company updates outside the widely reported tech sector. I think it's good to revisit that list as it should kind of inform our view of what's really happening in the world outside of, we'll call it, government statistics. Walmart and Target both commented last quarter about the resilience of the consumer. Both are seeing trade down activity as consumers spend on cheaper goods, which requires them to discount. By the way, that's when we talked about deflation earlier, they're discounting their products. But both of those companies are still seeing consumers spend. So that helps validate what we see in the high level economic data. Things are slowing down, but we aren't falling off a cliff into a recession. On the business capex side, Honeywell did well. So Honeywell makes big industrial equipment. They exceeded their expectations, but meanwhile, Caterpillar missed their revenue expectations on slower activity from customers than they expected coming into the year. Their revenues are again expected to be close to flat compared to 2023, so some slowing. Accenture had similar comments. Businesses are spending on large cost reduction transformations and less on more discretionary growth items. Their business is growing, but it's growing slowly. So businesses like consumers are being more conscious of cost and they're spending as the economy slows down. Financial services companies have a unique view, I think, of the consumer and consumer payment transactions data. So everybody kind of pays attention to their calls looking for that. MasterCard on their earnings call said that they saw record cross-border payments, indicating lots of overseas travel for consumers. So going to Europe is typically not something you do if you're very concerned about your finances. I think you see some of that in sort of the aging, older demographic population in the US. They have a lot of money and they're still spending it. That's what's keeping the economy afloat a little bit. JP Morgan continues to see kind of a reversal. They saw the travel expenses earlier this year. Now that's starting to peter out a little bit. But the important comment that the JP Morgan CFO made was that it's a reversal back to normal levels. It's not a big pullback in spending. It's just that, hey, the pop that we saw in some of the travel and entertainment spending post-COVID, we're getting towards the end of that, but it's not decelerating. It's decelerating, but it's not declining. We're just sort of getting back to normal. So let's shift gears and talk about stocks for a couple of minutes. We've seen a change in what's working since we did our outlook for the second quarter and since the second quarter earnings period this past August. You see for the year, growth stocks, particularly the Mag 7, are leading the way from a performance perspective. But there was an interesting thing that happened in August. So for the last 2 years, those companies have beaten expectations, and those beats have caused markets to raise future expectations for the stocks. So thus the price just kind of kept going up. So they beat expectations and then expectations go up and then they beat them again and then expectations go up and the price keeps going up. And that's how they reach those record high valuation levels at 20 or 30 times earnings. So that means the price that we're paying for the stock is, maybe 20 or 25 or 30 times their earnings, their profitability from either the current year or next year, depending on how you look at it. When valuations are that high, the market expects absolutely sort of astronomical performance, which it got until August. Companies like NVIDIA and Microsoft reported earnings growth. They did really well compared to their peers in the S&P 500. Microsoft grew its cloud business by 30%. That was more than expectations. NVIDIA was a similar story, but it just wasn't enough for the market for the first time in August. The stocks have underperformed since. Since July 15th, the equal weighted index, which is take away the market cap weightings, and so the stock market just taking the S&P 500 and having 1/500th of every company as opposed to having more exposure to some of those large growth companies at the top. That equal weighted index is up more than 8%, and the Mag 7 are essentially flat, just down just over 1%. So my view is that the market is finally priced in, at least for now, the future growth that it's going to price in for those companies. It's hard to time the market. It's simply being overvalued is no reason for a sell-off. The market was overvalued last year, it was overvalued the year before. We still haven't had a big sell-off. But I do think the performance around earnings last quarter is a clue that the Max 7, now that those valuations have run up so much, they just can't do enough to make the market happy. And so perhaps we get that change in leadership that I talked about a little bit in the upfront. Even beating expectations wasn't enough to drive prices higher. So at last, perhaps the long awaited rotation into all stocks except for the Mag 7 is here. That would also fit with an economy that's no longer slowing down, but starting to stabilize in sort of at a slow growth rate, right? Outside the largest companies in the US, small and mid-cap companies are continuing to have a really good year from a return perspective. Returns year to date are in the teens, certainly above their long-term averages. They still trail the large cap stock universe, though. Smaller companies are less profitable. They rely more on debt than their large cap brethren. That's not lots and lots of debt, but they generally have debt, whereas especially at the top of the S&P 500, there's sort of very little debt relative to the size of those companies. Small cap stocks have run up quickly when stories about reductions in interest rates because they have so much debt hit the news cycle. Those potential interest rate deductions, however, sort of my concern about that is those potential interest rate deductions in expenses and more profitability are happening because the economy is slowing down, which hurts small cap company profitability more than larger cap stocks. So my view that any rise in small cap stocks is likely to be more sort of short lived. I do think continuing to own smaller company stocks makes sense. So, but until we have enough data to confirm that the soft landing isn't going to turn into a recession, I would kind of tread lightly on that front. On the international side, the US continues to lead the way. That's been true really for the last decade or so. The common refrain is that stocks from Europe or Japan are undervalued relative to their US counterparts. As I mentioned before, valuation alone isn't an investment thesis. Some things are cheap because, well, they aren't worth very much. To be more comfortable owning lots of European and Australian stocks, we need a catalyst for driving future growth. I don't see that currently. The Eurozone continues to teeter on the edge of a recession. There have not been big macro level changes that make me believe that more innovation is about to materialize in Europe than the US. So I just don't see a lot of a catalyst there to drive European equities into outperformance. I do think that eventually they will figure that out, but I'm not sure that we're right on the cusp of that. On the emerging market front, I do think there's a more positive story in select emerging markets. As a reminder, my preferred approach in emerging markets is to be active, looking for great companies, not just investing in the index, which can be dominated by China because China has a really big economy, even though it's still developing. The move out of China that we've seen over the last couple of years as companies diversify their supply chain risk has really helped countries like India and Vietnam. China has rallied recently on expectations of sort of significant government stimulus to help fix the real estate market. And obviously, anytime you get significant government spending, you're going to get asset prices that are going to go up because you're essentially putting money into the economy. But I think that policy action is really fixing the wrong problem. Any form of large government stimulus, like I said, will juice the markets, and that's definitely happened in September and October. But the issue in China is the sort of long-term trend of saving versus spending. Their economy is geared towards exporting things and then saving the profits from those, not domestic spending like here in the US, where consumers make up the largest part of the US economy. So until they decide to encourage a change in behavior, I don't think China is going to get back on sort of the long-term growth path that we saw over the last couple of decades. So if you couple the lack of consumption with what appears to be sort of more isolationism from the Chinese Communist Party, you get a fairly negative outlook on that country in the near term. So when we think about investing in emerging markets, China is more than 30% of the MSCI Emerging Markets Index. So active management is really important so that we don't just have lots of China exposure in our emerging market portfolio. Since we're talking about international affairs, probably a good time to talk about oil, as the conflict in the Middle East seems to be dragging on and not winding down. I wrote about this on LinkedIn a couple of weeks ago. I published the stuff there generally twice a week. We had a baby this past quarter, so maybe a little bit slower in September, but generally a couple articles a week there on what's going on in markets and then some financial planning insights and tips too. Iran's sponsorship of terrorism is really horrendous. Okay. The human toll on the conflict, what's happening in the Middle East, it's terrible, right? Nobody wants to see that. Everybody wants to sort of find a solution that is peaceful. But from an economic perspective, Iran matters very little to the rest of the world. On the left-hand side of this chart, you can see the spike in oil prices in 2022 at the beginning of the Ukraine conflict. That kind of reflected the change that happened in the oil markets globally following Russia's invasion, and then subsequent U.S. sanctions on Russian oil. But prices have since fallen, and they've kind of remained range bound between 65 and 80-ish dollars a barrel as the market adjusted to sort of those new dynamics that were brought about by Russia's invasion of Ukraine. An attack on Iran's oil facilities by Israel, even if that resulted in a complete shutdown in production, would likely drive oil prices temporarily higher, kind of like what we saw in Ukraine, Russia situation. But Iran's production can be replaced by Saudi Arabia and other OPEC Plus members. According to the International Energy Agency, Iran produces about 3.1 million barrels of oil each day. Saudi Arabia alone has 3.1 million barrels of spare capacity. And then the other members of OPEC Plus have another 2 million barrels. So there's 5 million barrels of spare capacity right there. So that could easily offset what comes out of Iran. It's not in the interest of the other oil producing members to have prices so high that they cause a recession, right? And so $100 oil, things like that potentially does cause a recession. That's counterproductive for their economies in the long term. They prefer sort of stable prices, in my view, in the $80 range. As I've written previously, I think the world has more than enough oil to meet demand. We simply fight over sort of daily production amounts and prices, and they go up and down. So the only situation I think that poses a substantial risk to oil production is sort of a wider regional war in the Middle East that involves countries beyond Israel and Iran. U.S. oil production and energy independence always comes up as part of this conversation. You can see in the chart on the right that U.S. oil production is up roughly 50 million barrels a month over the last 3 years. Why haven't prices come down? I mean, you would think we're making more oil and prices should go down, right? U.S. oil independence, that's what we're all for. The reason is that oil is a global market. And so changes in U.S. production simply cause changes in other countries. And so we make more and other countries produce less. That doesn't mean that we shouldn't produce more oil in the U.S. There are great geostrategic reasons for the U.S. to not be dependent on foreign oil production if a conflict developed. But increasing production in the U.S. doesn't generally drive prices lower across the globe. At the beginning of the year, we talked about oil and other commodities as sort of trading assets for investors that like to make short-term bets on supply and demand. That's not what we do. So in our view, oil isn't particularly attractive as an investment asset at the moment. Even as a risk management tool, I think gold and bonds work better to hedge portfolios against potential sort of global conflict, more so than oil kind of at the current juncture. Let's talk a little bit about interest rates and bonds. We talked about these charts earlier in the year when the 10-year Treasury was yielding north of 4.5%. It was easier to make the case then that lower inflation should bring rates down over the long term. I expected that to play out over like 9 to 12 months, maybe into 2025. Instead, as usually happens, markets price things ahead of time. So we had rates fall from 4.5% to 4.2 over the summer, and then from 4.2% down to 3.6% in August. Really rapid decline in rates. And rates have recently backed up again a little bit, but they moved substantially lower since the second quarter. So the natural question is, how do we invest now that rates have begun to move a little bit lower in the sort of fixed income and bond side of our portfolio? Are rates low enough, or should we expect interest rates to continue to fall and subsequently increase bond prices more? We talked about inflation and the Fed earlier in this episode, but it's important to remember the economic backdrop when we talk about interest rates. Expectations for inflation and the Federal Reserve's policy ultimately cause market interest rates to go up or down, right? So we see the government inflation data as continuing to move lower towards that 2% target over the next couple of quarters. In our view, the Fed needs to continue to cut rates back to neutral to keep the labor market on track. The expectations for future Fed cuts have caused rates to move lower ahead of those cuts. The market is expecting the Fed to cut rates, like I said, to around 3.5% by the middle of next year. This chart has a lot going on, but it's helpful to understand the historical interest rate environment as relative to sort of where we are with inflation and the Fed sort of neutral rate. Before the financial crisis in 2008, we had this long period of falling rates. But where interest rates were generally higher and spreads, and that's a fancy finance word for the difference between, say, the 10-year Treasury rate and the inflation rate, or the spread between those two things. The spreads were wider in the 1990s and the 2000s before the financial crisis. After the financial crisis, the Federal Reserve embarked on a decade of quantitative easing that pushed rates and the spreads between different rates lower than they probably otherwise would have been if the Fed had just let the market sort of evolve more naturally. We also continue to see technological innovation, which drives inflation lower. Hello AI, right? As innovation makes everything across the economy cheaper and cheaper over time. So you have to adjust your inflation outlook for that. So in my view, we're going to continue to see innovation. We're not, the innovation economy is not going to stop. We're probably not going completely back to the 1980s or the 1990s from a rate and a spread perspective, but we are done with the significant amounts of quantitative easing that we saw from the Fed. So we should land somewhere in the middle of those two scenarios from the past, the sort of pre-COVID, or sorry, the pre-financial crisis period rate and spread levels, and the sort of post GFC pre-COVID time period. So when we think about the 10-year bond, the average spread for the 10-year between that interest rate and core PCE, which that's the Fed sort of preferred metric for inflation, was 3.6% in the 1990s and 1.1% in that financial repression period that followed the GFC. So if you assume inflation will land at 2, that means 3% is about as low as the 10-year should go, barring a recession. If you assume that inflation lands at 2.5%, then 3.5% is about as low as we should go without a recession. We got very close to that over the last quarter, 3.6%. That's where the 10-year yield was a month ago. So if we went all the way back to the 1990s, the spread should be closer to 3%, 3.6%. So inflation at 2% means a 10-year yield at 6.5% and 7% if you assume inflation moves higher. So again, I don't expect a reversion all the way back to the 1990s, but I think it's wise to assume that the 10-year treasury shouldn't fall much below 3.5%, unless there's a very real recession around the corner. So I think all that means that investors should be wary of adding additional long-term sort of fixed income exposure when rates are below 4%. But I do think the economy is going to continue to slow if, sort of on a rocky trajectory. So perhaps adding longer term fixed income when rates get back up into the fours is not necessarily a bad thing. Again, timing the interest rate market is so different than time the stock market. Is really, really difficult to do. So the best way to invest in bonds is to own a diversified portfolio over longer term periods of time. Make small adjustments around the margin. Don't try to go all in on one sort of set of interest rate expectations for the future. If we take a look at bonds outside of treasuries, remember the bond market is really big. We talk a lot about US treasuries, but there are actually way more bonds than stocks. It's a huge market globally. There are opportunities to pick up, in my view, additional yield by taking on a little bit more risk than those government bonds. I think owning a diversified bond portfolio protects against the risk, albeit remote, of the US government sort of missing a bond payment. And it's not so much about a US default, right? But just the fear around the budget deficit, et cetera, driving rates higher. You can see on the chart, high yield US corporate bonds yield almost 7%. Those companies do carry default risk, but our view is that extra interest more than compensates for the default risk of sort of typical non-recessionary years, which we don't think we're in. Emerging market country debt also carries a yield north of 6%. When you're buying higher yielding bonds, I think diversification is really important. These are assets that tend to lose value quickly when the economic cycle changes or when sort of unpredictable black swan events occur. Those things are by their very nature unpredictable. So diversifying your exposure allows you to minimize the chances that sort of an unforeseen event is going to impact a large portion of your high yield bond portfolio, and you can still participate in those higher yields and earn that income. Even with the economy slowing down, I think high yield defaults, they've still been really close to the historical kind of 4% range. So I think more importantly than the sort of overall level of defaults is that those defaults have been they've been occurring more heavily in the private side of the fixed income market. So you may have heard about private debt, leveraged loans, the bank loan market, those kinds of things. They have not been showing up as much in the publicly traded side of the market that we show here. We don't fully know the cause of that shift, but my view is probably the rise of private credit has increased competition for loans in that space. And that means that new private credit funds, they have to compete for a smaller pool of potential loans. That means they got to offer credit on more favorable terms than they otherwise should have. And the result of that down the road is that they carry more default risk than the publicly traded debt market. So diversify your high yield exposure, but if you diversify it and do it the right way, I think owning high yield is still not a bad thing, even though spreads have tightened a lot. And we're in a slow, but again, not in a recession part of the economy. If we move down the page, even high quality investment grade companies in the US, the blue line on the chart, those have rates north of the treasury line at the bottom as well. So All these kinds of bonds still benefit from lower long-term rates. So if you're building your portfolio out beyond treasuries, you still have the opportunity to pick up some extra income while those rates remain high, and you can still benefit as rates go down as well. Our last asset class is gold. You can see the gold price is up north of $2,800 an ounce. It's more than 27% for the year, like we talked about at the top. There have been two main drivers, both of which I would expect to continue at least through year end. The first is central bank buying. Central banks around the world have been buying more gold to replace their dollar reserves. Some refer to this as sort of de-dollarization. Sometimes that creates some consternation that perhaps the US dollar has a long-term problem. I view that's really far-fetched. What we've seen so far is more like a rebalancing. We've seen small adjustments from foreign central banks in their dollar reserves and trading some of those dollars for golds. And because their balance sheets are so big, even small percentage changes from dollars to gold can drive the gold price up a lot. The dollar is still the largest reserve currency or asset by far at most central banks, and I think that will be the case for the foreseeable future. All that buying activity seems to be continuing, so I would expect the price of gold to continue moving higher as central banks continue buying. The other major factor driving gold is lower interest rates. There's lots of investors in the world that look for safe haven assets, and when you're doing that, a lot of those folks sold gold when they bought short-term bonds or money market funds when rates were really high over the last couple of years. They could earn a high coupon and bet on rates to eventually go down. As rates come down, they give up for sort of holding gold, all that interest that they could have earned every month because gold doesn't pay interest. And that give up is less, the trade-off is less. And so it makes it a more attractive safe haven asset for investors. So I don't think gold will continue higher for years, but it seems like there's still plenty of demand from both central banks and investors for now. So, all right. Anyone notice that we have an election coming up? So I'll close this quarter on sort of potential outcomes and risks. As we sit in mid-October, the race is still essentially a dead heat. Former President Trump certainly has a recent momentum. He's been taking trips to McDonald's and sort of doing, I think, a lot of the right sort of things from a campaign perspective. And he's moved the national polling into a race that shows Vice President Harris with less than a 1% lead. Nationally, most pollsters think that Harris needs probably a 2 to 3 point advantage to win the Electoral College because she's going to get a lot of extra votes in population centers like California and New York. But she doesn't get any extra Electoral College votes for just winning by more and more and more and sort of running up the score in those states. Trump is also pulling ahead in most of the battlegrounds currently, which gives him an advantage, obviously, Electoral College. The problem is that both the polls and the battlegrounds are well inside the margin of error. So historically, the error has undercounted Republican votes in the last couple of elections and overcounted Democratic votes. So that's hence why folks think that Harris needs a bigger lead in order to actually win the election. But there's no guarantee that that's going to happen this time. There was a good article in the Journal this week interviewing pollsters, and they all have tried to close what they perceive as that sort of bias in the polls that we've seen in the last couple of elections. But none of them are sure that it's been closed. And they're also equally concerned that there have been periods in the past, like Obama's second election, where Democrats actually outperformed. So it's possible that they're wrong. So I think it's just important to frame it as it's still a very close race. Perhaps if you had to bet today, you give the slight nod to Trump. And if the trend continues in that direction, then he certainly would be the favorite going into election day. I did an entire podcast on the candidates' economic proposals earlier this fall. So if you want a real detailed conversation of all of their sort of proposals, at least the ones we had back then, because we've kind of gotten more, every day since then, but I refer you back to that video or that podcast episode. In short, both candidates have good and bad economic policies. Kamala Harris would raise personal and corporate taxes to fund more spending. That would directly reduce the earnings of stocks over the next few years. It's probably a 4 or 5% hit to S&P 500 earnings. But raising taxes requires help from Congress, and I think a significant increase is probably unlikely in a split Congress because it looks, regardless of the way the presidential election turns out, it looks like the Republicans are going to control the Senate. And so if Harris were to win the White House and have a Republican Senate, she's probably not going to get a lot of tax increases through, even if Democrats control the House. Trump would likely raise tariffs, which are inflationary at the margin. But it's more likely, in my view, that those increases are well below the sort of 10% starting point that he campaigns on, like his first administration. You couple slight tariff increases with a generally deflationary environment that I think that we're in. I don't see tariffs sparking a major rebound in inflation. Will it be higher at the margin? Sure, right? But you're probably talking tenths of a percent, something like that. So I don't think there's a huge risk if either candidate wins the election of huge policy changes. I think the real risk that's looming in the economy is the potential for a recession, and that's going to be caused by the Fed overstaying their welcome with high interest rates and pushing the economy there unnecessarily. Not anything that's proposed by either presidential candidate. So the market generally does well after the uncertainty around election wears off. So I have no reason to expect anything, sort of differently unless we get some sort of crazy red or blue sweep where we end up with a supermajority in the Senate or something like that. So what should you do as an investor given everything that we've talked about today? I think the first is don't get swayed by monthly volatility of economic data and the markets. The economy is doing fine. It's not doing great, but it's hanging in there. And some months are going to be hot, some months are going to be cold for the time being. Don't let those fluctuations influence your investment strategy. If you do that, you might get whipsawed. Consider diversifying your stock holdings. If you're significantly over allocated to US tech and the Mag 7, think about adding more to other buckets of your equity portfolio. If you've just been sort of sitting in S&P 500 index over the last few years, you got a lot of Mag 7 tech exposure. And if those things start to underperform, you can be missing out on returns elsewhere. So I'd think about diversification there. I also consider adding to the maturity of bond portfolios when rates are above 4%. Don't get suckered into buying them when rates go too low, right? And the drumbeat there is hard because rates go down into that 3.5% range when everybody's afraid of a recession. That seems like a great time to buy bonds, but don't get suckered into that. Buy them when they're up above 4%. And remember to diversify your bond portfolio too beyond treasuries to pick up all that extra yield in some of those other asset classes that we talked about. So as we move toward the end of the year, I have a couple of interesting episodes headed your way. We're going to do an episode on alternatives. So if you're interested in private debt, private equity, real estate, how those kinds of things fit into portfolios, we'll talk about that later this month. We'll also follow up on the investment implications of the election after we know the results. And we'll do an episode, as always, dedicated to year-end tax planning so you can make sure that you take advantage of the opportunities before December year-end comes around. So I look forward to seeing you soon, either in person or on the next episode of the Capital Stewards Podcast.